Proper asset allocation is absolutely one of the most important parts of becoming a long-term investor. So think about this. When you're young in that market cycle and you're just started that first company and you're investing in your 401, when you see wild swings on Wall Street, without panicking, you're so far from using that money that it can actually be a good thing, because when markets drop a lot, you're still investing, you're taking your hard-earned dollars and putting them into the market, and you're doing something called dollar cost averaging. This works out fabulously because you're buying more of hopefully a good item and you're buying more of it on sale. And then as the markets increase, you have more shares, you have more equities in it, and guess what happens? You see your portfolio go up and get bigger and bigger. But everything changes when you get in that retirement red zone, when you start getting into the place where you're going to actually start using the money in the future. Proper asset allocation is everything. Behind me, you'll see what we call the Callan chart, and this shows different asset classes. Well, this is a place where most investors don't even realize how that big box retail firm, they have never done a correlation matrix, and they have no idea of how diverse they are. What they see a lot of times is many mutual funds, but they have no idea they might be invested in some of the same things. So let's take a look at some of these big asset classes, and let's take a look at how, when people think of it as traders, trading, they go in and out, they're trying to time the markets and pick the right asset class to be in, versus investing. So when you look at this chart behind me, one of the things, let's take one of the asset classes like emerging markets. There can be some great growth in something like that. Very speculative, but it could be some really big upswings. So we're going to go back into 06, 07, and what you're going to see is in 07, you decide to invest in emerging markets. And in the top box there is that gold box, and it had 39% return in 07. You're like, this is amazing, I'm going to be rich. Well, we all know what happened in 08. So in 08, that same asset class lost 53%. Now think about this. You put 100,000 in, it made money. And so if it made, what is that, 37%, 39%? So let's call it 140,000 in there at the end of that first year. But then it lost 53%. Your 140,000 just lost over half of its money, and your initial investment of 100,000 is now way less than that, coming off of a huge year and then having one really bad year. So you just decide to get out. Or let's do a more recent example. Same thing. You jumped into emerging markets and you did it in 2017. And your $100,000 in that example had a 37% return. Let's say you ended up around 137,000. The very next year, it dropped 14%. Now, here's the problem. When you're young and you have a long timeline, it's okay, because guess what? You can withstand those wild swings. But there's few investors that have the fortitude to withstand wild swings down. Up is always good, but wild swings down, when you're thinking about retiring in 1 year, 5 years, 3 years, or you're, heaven forbid, you're 2 years into retirement. Look at this. Last year, 2020, emerging markets, 18%. Couple of years ago. Last year, 2.4% down, 2.5% down, and this year, over 20% down. Think about this, and that's just one asset category, but I can show you the wild swings on any asset category. This is why it's so important to have proper asset allocation and an extremely diverse portfolio, one that's designed to work within your risk tolerances. There's few investors, when they get into that retirement red zone within 5 years of retirement, or heaven forbid in retirement, that can withstand the kind of wild swings that we can prove happens each and every year in the Wall Street machine.